Section 1, Introduction to the Financial Markets. So, in this video, we're just going to go over what stocks are, what's the stock market. You know, like the stock market in itself, I want you to think of it as like a huge digital auction. It has a bunch of different markets, exchanges, and obviously participants. Me, you, institutions, investors, we're all participants in the market. We're all trying to buy and sell stocks and make money. Or the primary purpose of the market is, just to create an environment where companies can offer pieces of ownership in their company in exchange for money, and they might use that raise capital, fund different operations, expand their business, or just all the purpose is just to grow or raise money. Pieces of ownership are known as stocks, and then what companies will do, they issue a limited supply of shares in their stock. So I had the example right here. I bought 5 shares of Tesla stock. So Tesla will offer stock in the company, and that stock is the ownership, and then shares represent the pieces of stock or the pieces of ownership. So yeah, it's just important to know the difference between different shares and stocks, because people use it interchangeably, but that understanding the basic definition I think is still important. That's why I'm highlighting it here. So since the market is like an auction, it means that different stocks will have different prices, and all of those stocks are fluctuating and the prices are changing for a bunch of different reasons. But at the end of the day, it's because people are buying and selling, and when people are buying and selling, that means there's a supply and there's a demand. And obviously we'll get into that. But when investors or people like me and you participate in these options, in these auctions, we're just doing it because there's opportunity to make money. And stocks can increase in value infinitely, or they could decrease until zero. So they can only reach zero and become worthless. Like a stock cannot go negative, but they can always just keep going higher and higher and higher. So here's an example. Apple stock. We all know Apple. Apple is listed on the stock exchange, and it has this symbol or word, whatever, and that's known as a ticker. So different stocks have different ticker names, and that's just how you would actually go in the market and type in the company, so you can look at their specific stock and their chart and everything like that. So say I buy Apple stock for 25, and then I sell my stock 1 year later for $30. I would have made money on that, and that's the whole premise of the stock market. And I would have made a profit of $5 because you just want to buy something for the potential that is going to increase in value. And then for people to really make money trading or investing in stocks, that's why you want to have as much as possible. So Apple stock is just continuing with that off of that previous example. Apple stock is listed at 25, and you think that's a great price, so you buy it. And then Apple stocks increases to $30, and you have $1,000 that you want to invest in Apple. So if Apple stock, you buy it at 25 with $1,000, you end up buying 40 shares, and then you sell those 40 shares later, a year later, at $30. So that means your 40 shares of Apple that were worth $25 per share are now worth $30 a share, and that $1,000 that you invested is going to be worth $1,200 or $1,200. So you made $200 or a 20% return on your investment. And if you're trading stocks, or if you come in here to learn how to trade stocks, you understand that a 20% return is a good return, and that's, again, the whole premise of the stock market in order to grow money. And obviously, the more money you have, the more shares of a stock you can buy, and the more you own means the more you can make. And just highlighting again, there's also risk. So you can also lose money if the investment doesn't go as planned. So if you bought 40 shares of Apple at $30 and sold them at 25, you lost 200 or negative 20%. And then that $1,000 you put in would only be worth 800. But just because it lost value in that moment, technically, you don't really lose money until you sell and actually execute that position. So once you sell it, you would only get $800 back because that's what it's worth at the time. But lots of different things happen in the market. Reminder, it's like I told you, it's an auction. So you always have the potential that it could go lower, it could go higher, and that's just the risk that that's just what you're getting into when you come in to trade stocks and eventually options. And again, that's why people participate in the stock market because of the potential to have their money make money. And obviously, that's the best thing that you can do in order to change your life, right? So,